Today, we're going to crack the code on what is, without a doubt, the single most important rule in all of finance. It's a rule so fundamental, it literally keeps the entire world of business in perfect balance. I mean, think about it. How can a tiny coffee cart on a street corner and a massive global corporation follow the exact same financial rule? It seems impossible, right? But it turns out their entire financial story is built on one simple, perfectly balanced equation. So what is this universal secret code? Let's dive in and find out. All right, to really get this, we're going to start from scratch. Forget about complicated spreadsheets and corporate reports for a minute. We're going to build the simplest business you can possibly imagine. Let's say you decide to start a business, a coffee cart. You take $30,000 of your own savings and put it into a new bank account just for the business. Now, at this exact moment, the business has just one thing, cash. And this brings us to our very first key term. That 30 grand in cash? In accounting, we call that an asset. It's really just a word for a resource the company owns that it can use to make money in the future. So the business has something, but where did it come from? Well, it came from you, the owner. Your investment represents your claim on the company's assets. And that has a name too, equity. The easiest way to think about it is that it's the owner's stake in the business, your piece of the pie. And just like that, we have the equation in its simplest form. The assets the business owns, that $30,000 in cash, are perfectly equal to the owner's claim on those assets, your $30,000 investment. It's a perfect balance. But of course, businesses rarely stay this simple. So what happens when we need to grow? So right now, the business is funded entirely by you. But what happens when you need money from someone else? Let's see how bringing in an outsider completely changes the equation. Your coffee is a massive hit. Business is booming, and you need a much better machine to keep up with the demand. A professional one costs $10,000, and you don't want to use up all your cash. So you head over to the bank and you get a loan. This introduces our third and final piece of the puzzle. That loan is a liability. Now think about this. It's also a claim on your company's assets, but this claim isn't held by you. It's held by an outsider, the bank. So a liability is simply what your business owes to other people. And with that final piece, we can reveal the whole shebang, the fundamental accounting equation. Assets equal liabilities plus equity. Now, this is not just some random formula. This is the bedrock of all accounting. Every single financial report you have ever seen is built on this one simple, elegant piece of logic. You know, here's another way to think about it that might make it click. The left side of the equation, the assets, shows how the company used its money. It bought stuff. The right side shows where that money came from. It was either borrowed from outsiders, which are the liabilities, or it was invested by the owners, which is the equity. The uses must always equal the sources. It just makes sense, right? Now, the real magic of this equation is that it's a living thing. It's constantly adjusting with every single transaction, but it always stays in balance. Let's look at a few examples to see how this incredible balancing act works in the real world. This whole balancing act is the core idea behind what's called double entry accounting. All that means is that for every transaction, there isn't just one effect. There are at least two. I like to think of it like an old-fashioned scale. To keep it level, every single action has to have an equal and opposite reaction somewhere else. Okay, let's put it to the test. You buy a new $2,000 oven on credit. So what happens? First, your assets go up by $2,000 because, well, you have a new piece of equipment. But since you haven't paid for it yet, your liabilities also go up by $2,000. Both sides of the equation increased by the exact same amount. Perfectly balanced. Okay, but what if you buy $500 worth of coffee beans using cash? Now, this one's interesting because the action is all on one side of the equation. Your assets, in the form of inventory, the beans, go up by $500. But at the same time, your assets in the form of cash go down by $500. You basically just traded one asset for another. The total value of your assets didn't change at all, and the equation is still perfectly balanced. So let's just put it all together and recap our little journey. We started with a simple balance, $30K in assets, $30K in equity. Then, buying that oven on credit bumped up both our assets and our liabilities by $2,000. Buying the beans with cash was just a swap inside the assets bucket. And where do we end up? With $32,000 in assets, which is perfectly matched by $2,000 in liabilities plus our original $30,000 in equity. See? It always balances. Okay, so now that we've got the overall structure down, let's zoom in a little bit and add some detail to each of these categories. You see, not all assets are created equal. Accountants like to group them based on how long they're going to stick around. Current assets are things you expect to use up or turn into cash within a year, like cash itself or your coffee beans. Long-term assets are the things that provide value for more than a year, like your actual coffee cart and that fancy espresso machine. Here are a couple more examples to make it really clear. Simple stuff you can touch, like office supplies. That's a classic current asset. It gets used up pretty quickly. But some of a company's most valuable assets are what we call intangible. Things like patents or trademarks. You can't touch them, but their value can last for years and years, which makes them long-term assets. And you guessed it, liabilities have their own categories too. Short-term obligations include things like accounts payable, which is just a fancy way of saying bills you owe to your suppliers, and salaries payable, for wages you owe to your employees. Then you've got the bigger, more formal debts, like that bank loan or a mortgage on a building. Those are your long-term debts. And finally, let's circle back to equity. It's not just the money you initially put in. It's a dynamic number that really reflects the health of your business. Every coffee you sell generates revenue, and that makes your equity go up. Every bill you pay is an expense, and that makes it go down. In this way, equity becomes a kind of real-time scorecard for your company's profitability. And for a big public company, this equity is what's owned by all the shareholders. So a rising equity value is often why you'll see a rising stock price. So we have this elegant, always balanced equation. It's pretty cool. But why is it so important? I mean, what does it actually tell us about the real world? I love this saying, the accounting equation is the skeleton that holds up the entire financial system. It's not just a rule for bookkeepers. It's a universal language that allows anyone, investors, lenders, managers, to understand the financial health of a company at a glance. It's a reliable snapshot of where a company stands at any given moment. And that snapshot can reveal a ton. On the left, you see a healthy company. It has more assets than it has liabilities, which leaves positive equity for the owners. That's good. But the company on the right, well, it's in trouble. Its liabilities are greater than its assets. This is called negative equity. And it means that even if the company sold everything it owns, it still couldn't pay off all its debts. That is a dangerous place to be. So this equation gives us a perfect, balanced picture of a company's financial position today. But the real power, the real story, comes from tracking these numbers over time. When you do that, you start to see a narrative unfold. So I'll leave you with this final thought. If one snapshot tells us where a company is, what can a whole series of snapshots tell us about where it's going?